Hello, everybody. Welcome to today's presentation. Today, we're going to be talking about a new piece of tax legislation titled the One Big Beautiful Bill Act. Signed into law on July 4th by President Trump, was kicked back and forth in the House and the Senate for a few weeks and months prior to then. But ultimately, one of the biggest pieces of tax legislation that we've seen in many years. Whenever there's a new piece of tax legislation such as this one, where we expect it to impact many different types of demographics, different age ranges, whether you're a business owner, you're an individual filer, we get excited. I think there's a lot in here to unpack. We're going to go through a lot of provisions tonight. There's a good amount in here that we can create strategy off of, which I'm excited to share with you. This piece of legislation is large, 870 plus pages, 10 different sections. The section we're going to spend only our time on this evening pertains specifically to the tax provisions in the bill. It's also large from the perspective that there's something in here for newborns, new account type. There's something in here for seniors. There's something in here for business owners. There's a whole bunch of extensions of tax provisions from the Tax Cuts and Jobs Act carried forward for individuals, income tax brackets, estate tax exemption levels, a car loan deduction, all sorts of different things that can impact the way and how much we pay in income taxes. Now, it is big, and one thing that our firm and myself, in preparing for this presentation, I feel is very important, is staying dead center down the line from a political perspective. And so depending on your definition of the word beautiful, it may be that or it may not be. There's pros and cons to this bill. And so from our perspective, objectively, from the seat that I sit in, as somebody who sees my role as trying to identify opportunities to reduce my clients' expenses, and the number one expense that in our experience we've found for retirees and just for individuals overall, income taxes, right? Finding ways to reduce their income taxes tends to be a good thing. All right. So, many of you know us, have been clients of ours for years, but for those of you who may be new to us, there is zero political slant in our presentations. We're going to stay right down center here. From my perspective, I love trying to explain complex topics in simple to easy to understand terms. I feel like it's often a very difficult task, but it's something that we are responsible for. Now, in terms of a framework here, I figured we could start with the who, what, when, where, and why. The what and the where. So what are the provisions in this tax bill? We're going to talk a lot about that in subsequent slides. The where can we apply those provisions to create strategy off of? We're also going to touch on that later in this presentation. So for now, let's just focus on the who, the when, and the why. Who, whether you're retired, you're a newborn, you're a parent, you're a business owner, you're a corporation. Like I said, there is something in this bill for everybody, okay? When? What makes this bill more complicated than most is that there are staggered start and stop dates to many of the provisions contained within this bill that are new. In addition to that, many of the provisions that were in the Tax Cuts and Jobs Act, which is enacted also by President Trump, but back in 2018, many of those provisions are carried forward through the One Big Beautiful Bill Act. And there is a term you're going to hear me use quite often to describe some of those carried over provisions, and that word is permanent. Now, the dictionary definition of permanent is quite different than the definition of permanent in tax code lingo. And all it means, permanent means in tax code lingo, is it exists until another Congress comes along and changes it. So there is really, the dictionary definition of permanent does not apply to anything I talk to you about when I tell you this evening that it is permanent. And then the why. So from a why perspective, why was the One Big Beautiful Bill Act, brought forth here? And the primary reason is really no different than the Tax Cuts and Jobs Act, which was to stimulate economic growth. We also saw provisions in the Tax Cuts and Jobs Act, and here being carried forward in this bill, simplifying the tax code. We have the standard deduction, which is continuing to be increased. But really, in 2018, one of the biggest takeaways from that bill, the Tax Cuts and Jobs Act, was prior to that, many folks itemized their income tax deductions. And afterwards, because the standard deduction was raised so significantly, far fewer do so now. Going forward, I would expect far fewer, that same amount to continue taking the standard deduction. And that simplifies things. Think about it. If you're an IRS audit agent and your task is to find mistakes or mistakes that people are making on their return, maybe reporting things that they shouldn't, if they're just taking the standard deduction and not itemizing, well, that's a whole heck of a lot of audit work that you don't have to do. And then also a big why for the One Big Beautiful Bill Act is just carrying forth those Tax Cuts and Jobs Act provisions previously enacted by Donald Trump. Okay, so the most important point that you need to know this evening, all right? And if there was one takeaway that I feel you should have by the end of this presentation, it's this slide. So the Tax Cuts and Jobs Act was always intentionally designed with temporary provisions that were going to sunset at the end of this year. And there were some fairly significant ones, and we're going to get into those in a few slides. But just know that the Tax Cuts and Jobs Act of 2018 was designed to be temporary, and many of the most important provisions were set to sunset at the end of this year. Now, here we are, 2025, where the One Big Beautiful Bill Act comes along and extends, makes permanent. You see in quotations there that word permanent. It extends many of the provisions from the Tax Cuts and Jobs Act indefinitely into the future. And remember that word permanent until some other Congress comes along and decides that's not the case, right? Now, what's super important about this is that we're going to talk about it here in a second, but ultimately, the One Big Beautiful Bill Act prevents the tax code from reverting back to pre-Tax Cuts and Jobs Act levels. And many of you will recall what the Tax Cuts and Jobs Act did was it lowered tax rates for both individuals and corporations, okay? And to have that bill sunset, right, go back to what the tax rates were before that Tax Cuts and Jobs Act, well, that would have meant that tax rates were going to go up. So the most important point that you need to know about the One Big Beautiful Bill Act is that it keeps tax rates historically low. It extends those rates from the Tax Cuts and Jobs Act. And we're going to take a look at that a little bit more here on this slide. So we have a simple graph here. On the y-axis, we have different levels of taxable income all the way up to $700,000 and change. And then we have two bar charts. The bar chart on the left represents the federal marginal tax brackets and their rates today. And then the bar on the right represents what those tax brackets and rates were before the Tax Cuts and Jobs Act. And as I just described in the slide before, what they would have gone to next year had the One Big Beautiful Bill Act not been enacted. We're going to pick a very simple right down the middle bracket and right here, the 24% bracket. As you can see, a lot of folks in that bracket would not have been happy had the One Big Beautiful Bill Act not been passed. Their federal marginal bracket would have gone from 24% to 33%. And as you can see, even on the brackets at the low end, 12 to 15%, the 10% stays the same. But across the board, all tax rates were set to go up had the One Big Beautiful Bill Act not been passed. All right. So my goal in whenever doing a presentation like this is to ensure that not only are we talking about some of the provisions in the bill, but that I'm not just reciting facts, simple things that can be found in a Google search. So the way I broke this presentation up is into 4 sections. The first, we're going to talk about the most impactful provisions in the One Big Beautiful Bill Act. The next section will be the biggest misconceptions, something we were told was going to be in the bill, but it actually turned out to be a little bit different. Third, the most surprising provisions. And then fourth, the provisions with the biggest limitations. So first up, the most impactful. The most impactful by far are the extension of the income tax brackets from the Tax Cuts and Jobs Act for individual tax filers, as well as the maintenance of the estate tax exemption levels. First, let's talk about the income tax brackets. At the end of the day, we talked about this in a couple of slides over the past minutes or so, but we're talking about low tax brackets being carried forward. And so whenever we know that clients are in an environment where low tax brackets are there for the foreseeable future, the goal is to always figure out ways to have taxable income hit your tax return to take advantage of those lower tax rates. Okay. Obviously, we wouldn't do that just willy-nilly without your consent, and if it did not align with your goals and objectives. But at the end of the day, it's worth a discussion. The other thing that the the One Big Beautiful Bill Act did, which is extremely impactful for many of our clients, is that it carried over the estate and gift tax exemption levels. In 2025, an individual can leave roughly $14 million. It's roughly $28 million for a married couple, double the single filer. They can leave that amount to their heirs without facing the federal estate tax. Okay. And the estate tax is roughly 40 cents of every dollar. All right. So it's a 40% estate tax rate. And most folks don't want to send 40 cents of every dollar over those levels on a one-way trip to Washington, D.C. So there's a ton of financial planning, estate planning, tax planning work that goes into making sure that that doesn't happen. Now, again, remember, one of the things that the Tax Cuts and Jobs Act did was it significantly raised the estate and gift tax exemption levels at the federal level. If the One Big Beautiful Bill Act had not been passed, you see in this maroon color here, the 2026 reversion amounts, we would be cutting in half the amount that a single filer and a married couple could leave to their heirs without facing the estate tax. That is a significant cut, right? And many of our clients would be in a position where we'd have to start thinking seriously about potentially getting assets out of their estate. Now, what the One Big Beautiful Bill Act did, it carried forward, no different than the income tax rates and brackets, it carried forward the estate tax exemption levels, and in fact, it actually increased it. So for next year, an individual can leave $15 million without facing the estate tax. They can leave $30 million for a married couple without broaching the estate and gift tax exemption levels. And so what does that do? What's the strategy there? Well, really, everyone was extremely worried about this who had the level of wealth where it was going to be impactful to them. What it does is it buys them a lot more time now. You have a lot more time to think about a thoughtful estate plan. You have a lot more time to think about whether you need or want to get assets out of your estate. And you have a lot more time for assets to stay in your estate and to hopefully receive that step up in basis. Okay. Okay, so that's it from an estate tax perspective. Let's move on to the biggest misconceptions. What were the biggest misconceptions in this new bill? Well, we were marketed throughout President Trump's campaign trail, and then especially over the past couple of months, that there were going to be a series of sources of income that were not going to have any tax on them. And there are three in particular that made their way into the One Big Beautiful Bill Act. Tip income, overtime pay, and Social Security. Now, we were marketed by the president himself that these sources of income, there were going to be no taxes on them. No tax on tips, no tax on overtime pay, and no tax on Social Security. what actually made its way into the bill, and the way we are actually receiving that income is not by getting taxed on it. We are still getting taxed on it. It's just we may be eligible for a deduction based on all sorts of qualifications that we'd have to meet that may help reduce our taxes as a result. Okay, so we were marketed that we'd have no tax on tip income, but in reality, what we're getting is a deduction against your qualified tip income. You've got to be eligible for it. It only exists from 2025 through 2028. You have to have income below a certain level for both tip income and overtime pay. You can't be considered a highly compensated employee, meaning you have to have less than $150,000 of income from that job in order to qualify for the deduction. For the overtime pay and the tip income, the deduction does not flow through onto your state tax return, and you still pay FICA taxes, payroll taxes on that income. So that's a little bit about how things are happening with the quote unquote no tax on tips, quote unquote no tax on overtime pay. Now, no tax on Social Security. This one is more interesting to me. And what I can say for certain is that this, first of all, the name of the deduction is the Enhanced Senior Tax Deduction. It actually doesn't have any ties whatsoever to Social Security. You can be earning Social Security and not be eligible for the deduction. You can be receiving Social Security and not get the deduction. So really the line in the sand, the biggest qualification here is to be over the age of 65. For single filers, you can receive up to an additional $6,000 deduction. It's double that for married filing joint couples. On top of your standard deduction, the enhanced senior tax deduction starts in 2025. A married filing joint couple can have, with this, if they qualify, if their income is below certain thresholds, they can start right off the bat with their standard deduction plus the existing senior deduction plus the enhanced senior tax deduction of somewhere close to $45,000, $50,000 of deductions right off the bat, which is great. But again, bit of a misnomer. If we're walking the streets saying to ourselves, this bill allows folks not to pay tax on tips, not to pay tax on overtime pay, and not to pay tax on Social Security, that's just simply not correct. And so these are the biggest misconceptions that made its way into the bill. Now, the most surprising provisions, easily, without a doubt, the SALT deduction cap increase. So you've probably heard about this one. It was the reason why it was the most surprising, to be honest with you, is because it was the most hotly debated. High tax states wanted the SALT deduction cap to be increased. As a refresher, SALT stands for state and local tax. We get a federal deduction for the state and local taxes that we pay. Whenever, high tax states, in the Tax Cuts and Jobs Act back in 2018, we used to be able to deduct all of our state and local taxes if we itemized. Then 2018 comes along, the Tax Cuts and Jobs Act caps the max amount of our state and local taxes that we can incorporate on our itemized deductions at $10,000. The One Big Beautiful Bill Act has now increased that cap to $40,000, right? So residents of high tax states rejoice. This deduction is in force from 2025 to 2029. So again, we just talked about the no tax on tips, overtime pay, 2025 to 2028. Now here we are with this deduction, 25 to 29. So going back to my slide from my intro slide, the staggering start and end dates makes this kind of a confusing bill. One of the bigger things here is that this deduction was the 40,000 from the 10,000 was primarily designed to help middle income earners in high tax states. And the reason why I say that is because there is an income phase out for whether you are a single filer or a married filing joint couple. If you make $500,000 or more, that $40,000 cap starts getting reduced back down to $10,000. All right. And if you make actually over $600,000, you lose the full increase. It's $10,000. You're back to the $10,000 cap. Okay. So that's, and the last thing with the SALT deduction cap is that there's, ever since it was enacted back in 2018 under the Tax Cuts and Jobs Act, there's been this whole debate about this deduction hurting married filing joint couples. And the reason why they say that cap applies to single filers. The same amount also applies to married filing joint. What we typically see in the tax code is that married couples, because there's two individuals, not one, they receive double the cap or double the income amount phase outs than individual filers. And that's not, it's actually been made worse in the One Big Beautiful Bill Act for this deduction. So that marriage penalty still exists, but there's more opportunity for folks to be able to itemize their state and local taxes going forward. The biggest limitation, we have one new account type, the Trump child accounts, and then we have some updates here on 529 accounts. I actually went back and forth on the Trump child accounts. I actually think it's wonderful that the U.S. government is willing to seed newborns with free money to invest for their future. So from that perspective, I think it's an underrated provision. Where I ultimately landed was thinking through it from the lens of how would I use this account beyond the free money that the government's willing to give me? Would I fund it even further for my own children? And the answer that I arrived at is, based on the way these accounts work now, no. And so that's why it landed within the section of biggest limitations. Let me walk you through that a little bit here. So the Trump accounts, a little bit about those. They work very similar to the way an IRA does. Money goes in, it's tax deferred, and then ultimately when it comes out, it's entirely taxable. It's designed specifically for minors. Anybody with a newborn between 2025 and 2028 can receive a free $1,000 seed investment from the United States government. It has to be a U.S. citizen being born. Contributions are limited to $5,000 per year. Parents, grandparents, and employers can actually contribute to these accounts. Now, considerations. So absolutely, if you have a child or a grandchild, being born between this time frame, get your free $1,000, no doubt about it. Now, let's talk about some of the limitations here. As of today, the way that the new accounts are structured, the investments, the investment vehicles within them are extremely restricted. You can only invest in very broad-based stock indexes. So, for example, the S&P 500. And the funds that are available within these have to be very low-cost investments, which I think that's a great thing. But hear me out here. So this account, it works like an IRA. I, as a parent or a grandparent, I don't get a tax deduction for putting money into it. There's restrictions all along until the child is age 18, and then when they take the money out, it's fully taxable. Whereas, let's say that I put the money, let's say I wanted to contribute $5,000 a year, and I put the money into a regular taxable account, all right, a non-IRA account. And at worst, the dividends being issued by that S&P 500 index or stock market index is taxable each year as income. To be honest with you, I'm okay with that. And the reason why I'm okay with that is because the dividend yield on the S&P 500 is currently less than 2%. It's very low. And even so, the income coming off of that is considered qualified dividend income, meaning it gets taxed at preferential rates. So at the end of the day, the tax drag on an account that is not this Trump child account or an IRA, for example, the tax drag on a non-IRA account is very low, okay? So do I really care about the tax-deferred benefits of this Trump child account? when I can go and invest the same money in a non-IRA, non-Trump child account. Yes, I'll have some tax drag, not much though, as we just discussed. And there are no restrictions on what I can use that money for. I can use it for education. I can help my child buy their first car. If the education system turns out completely different in 17 years when my daughter goes to school, I don't have to, it's, I just feel like thinking that through, I'd probably rather have the money growing in a different account than this one, purely because of the restrictions and limitations that are placed on it. Moving on, the 529 accounts. We have a couple of new updates to the 529 accounts. Really not much though. You can use, instead of $10,000, now $20,000 for expenses related to K through 12 schooling costs. The biggest miss and limitation that still exists on the 529 accounts, which was not updated in the One Big Beautiful Bill Act. A couple of years ago, we were given the ability to be able to roll money out of our 529 plans and into Roth IRAs for the benefit of the beneficiary of that account, for our child or grandchild, subject to a lifetime limit of $35,000. So sounds great, but if you overfunded your 529 accounts by too much, which a lot of parents or grandparents have, they have money sitting in 529 accounts that they can't take out because of the potential penalties or taxes associated with it. And the beneficiary has already graduated college. So they overfunded the accounts but can't get the money out. Well, wouldn't it have been great if the U.S. government created some relief or some avenues for relief, maybe allowing more money to be rolled over into a Roth IRA? In my opinion, yes, but this One Big Beautiful Bill Act did not address that. It did not enhance those limitations. We have some other notable provisions contained within the bill. We now have a charitable giving floor. This is giving, for example, cash to charity. You have to surpass 0.5% of your AGI in order to be able to start deducting your cash charitable gifts on your tax return. It works very similar to the way you're being able to deduct medical expenses on your tax return works. Remember, as for medical expenses, you have to have accrued an amount of medical expenses in excess of 7.5% of your adjusted gross income in order to be eligible to deduct those medical expenses on your tax return. This works very similarly. We have the elimination of certain clean energy tax credits. If you're looking to buy an electric vehicle, you should do so before October 1st. If you're looking to make energy efficient home improvements, you should do so before the end of this year. We have a new auto loan interest deduction. You can deduct up to $10,000 of interest on a car loan, newly purchased U.S. assembled vehicle, and that exists from 2025 through 2028. There's lots of fine print around that one. And then lastly, there's a slight increase to the child tax credit, not much to make a huge deal out of that. This bill, like its predecessor, the Tax Cuts and Jobs Act, is expected to increase deficit spending as well as our national debt. We see some of that being offset by some of the tariff policy from President Trump and his administration, but not nearly to the extent where it would fully offset the reduction in taxes that the IRS would earn as a result of the One Big Beautiful Bill. And so as a result, there are potential market implications as a result of this bill that we are keeping an eye on. And that's really part of our job and why you hire us. There's three areas here that this bill could have an impact on. Growth, from a positive perspective. We may ultimately see a short-term lift to economic GDP and corporate earnings. Remember, we didn't really get much into a lot of the business deductions as that were extended as part of the One Big Beautiful Bill Act from the Tax Cuts and Jobs Act, and also enhanced in the One Big Beautiful Bill Act. But ultimately, just know that this bill is designed and it's incentivizing businesses to spend money in the economy. And so as a result, we may see a boost to GDP as a result. And remember, whenever somebody goes out and buys an excavator for their company and is able to and is incentivized by a deduction as a result of a tax bill like this one, if they buy that excavator from Caterpillar, that's a boost to Caterpillar's earnings, right? And so we may see a lift to corporate earnings as a result. Ultimately, at the end of the day, I think the next two are the biggest things that we're paying attention to because they have longer term potential impacts is, keeping an eye on inflation. Theoretically speaking, if we're all paying less tax or low historic tax, then there's more money for us to go spend, more dollars floating around in the economy, and there's the potential for inflation to increase. We will see if that comes to fruition. We also have the fact that the tariff policies that were put into place in, the last quarter or so, if those actually flow through into the inflation and GDP figures as well. I would imagine that much of that is still coming. And then debt. So, no different than if two people go to a bank and ask for a loan. Person A has a lot of debt. Person B has no debt. The interest rate that bank is going to charge both of those people is going to be different. Somebody with a lot more debt is a higher risk credit, and the interest rate they may pay on a loan coming from the bank is higher than what somebody with no debt might pay. It works very similarly when countries issue debt. Remember, the United States is in the business of selling debt to the rest of the world, issuing treasuries. That's what bonds are. Now, whenever the rest of the world sees the United States continuing to increase its deficits and expanding its national debt, there's always the worry that as a result, markets become more volatile and, the world may require the United States to pay a higher rate of interest on its debt if the rest of the world deems it a riskier credit. Now, there's a series of implications for that, which have not come to fruition. Remember, the United States, despite the fact that we are adding more debt, is by far not the country with the highest total, debt to GDP. And there are certainly lots of other countries that are in worse positions. Plus, I would argue that the United States has the greatest potential to grow itself out of its debt problem over the long run. Nevertheless, it's something that we need to keep our eye on, and we've identified that. And if there's changes in our portfolios that are warranted as a result of this One Big Beautiful Bill Act or the impact that it may have, we will most definitely make that. So that is the end of my presentation. I want to thank you for joining today. And if you have any questions, please do not hesitate to reach out. I want to make sure that if there's a specific section in this bill that you have questions on, for example, maybe it's the car loan interest deduction, maybe it's just, describe to me again the tax brackets that exist. Please do not hesitate to reach out. And thank you for joining.